Hello, I'm Shaun Robson,
And I'm Will Stevens.
and we're here today to talk about the impact of the upcoming budget on clients who are potentially factoring in longer-term care costs for their parents, juggling that with the cost of perhaps a young family, and also considering their own retirement in the near future. Will, perhaps you could give us a few thoughts on how those individuals might be impacted by the upcoming budget that's been announced for the 30th of October.
Absolutely. So one of the key concerns that a lot of clients have been discussing with us, and a significant portion of our clients fall into this category of approaching or recently into retirement, and therefore trying to work out how they fund the rest of their life to make sure that they can keep living the life that they want to live. These individuals tend to have amassed different types of assets in their lifetime. Maybe they've got second homes, buy-to-lets, pensions, other investments, and the tax treatment across those could potentially change in varying different ways. So we've had a lot of questions on pension tax and legislation, but also a lot of questions around capital gains tax. Today, capital gains tax is at relatively low rates. If you look back historically, the allowance for capital gains has come down significantly over previous years though. So only 2 years ago, the allowance for any individual for capital gains tax in any 1 year was over £12,000, came down to £6,000, and now it's down to £3,000. But the headline rates have remained the same, 20% for higher rate taxpayers, 10% for basic rate taxpayers. Those are slightly higher for residential property that isn't a main residence, and those are actually down from previous levels. Prior to coming into power and since being in power, the Labour Party has not said anything around capital gains tax and what their plans for it might be. In fact, it's been noticeable in its absence in a lot of ways, which has caused people a lot of uncertainty. And that's where we have tried to step in to answer questions on potential solutions for them. I think one of the things we would probably say is that the capital gains tax position isn't likely to get any better. The allowances aren't likely to go up. The tax rate isn't likely to go down. So knowing that, it's a case of considering what were to happen if it were to go up. The second thing that I think we've had a lot of questions on is potential changes in pension legislation. That these are much larger changes. They would be structurally different to the pensions environment than most people are accustomed to. And most people are accustomed to a very specific pension regime that's been in place for quite a long period of time. So there have been rumours around, will they continue to maintain tax-free cash in its current entitlement, which is 25% of the value of your fund, up to the limit. The limit's sort of north of £267,000, there or thereabouts. But if that were to change, that would be quite a significant change for most people. They've been very used to that allowance. Most people have planned based on that. There are some individuals who intend to use that to, for example, repay their mortgage. The other area that's been talked around is if you are still working, are you going to qualify for the same level of tax relief? Are you going to be able to put the amount into your pension that you want to in order to boost it, hopefully just before you move off into retirement? And then trying to match those concerns with also, as you pointed out earlier, financially maybe looking after children and also parents who are maybe getting on in their years and maybe needing care home costs and things at this stage can put quite a lot of pressure on those individuals. So I think that's where we step in to try and help with that. And I guess touching on that sort of more elderly parents realm, for those who are about to inherit or who have recently inherited, if capital gains tax is in a position where investing a lump sum is becoming more difficult, are there things that those individuals could be looking at?
Yeah, absolutely. So at a time of inheritance, it's a good opportunity to review your own financial situation and understand the impact of that inheritance on your own lifestyle, your own needs, and usually clients in this situation are also considering younger generations at the same time. And as they move into retirement and looking at their own needs, balancing that with what the younger generations may need. So it creates opportunities. Things to consider might well be things like deed of variation. in the will,
Yep.
in terms of the assets that have been inherited. If you're in a position where potentially you don't need those assets yourselves, and a good way of analysing that is to go through a cash flow planning exercise to understand what your needs are for the rest of your lifetime. That will help you understand if you need the inheritance, or whether actually that could form part of your future succession planning yourself, and perhaps helping your children themselves in terms of their own objectives and ambitions as they start to build their own careers, and maybe potentially want to get onto the property ladder, potentially even younger generations for school fees planning, etc. Beyond deed of variation, it's also looking at potentially, if you need to keep the asset yourself, how do you invest that tax efficiently? We often talk in our videos around tax wrappers, things like ISAs, pensions, and there are other tax structures that enable you to save tax efficiently. So that would be something that clients should be given consideration to, is am I investing as tax efficiently as I possibly can? So lots of conversations we're having with clients around perhaps those portfolios that aren't tax wrapped, where the impact of CGT would be felt the most, and whether it's the right time to consider perhaps reshaping those portfolios, maybe looking at taking triggering some capital gains tax now ahead of the budget, but having a plan for what to do with that afterwards. It's quite clear that you need to make sure that if you do go and pay CGT ahead of the budget, that you are planning around how you make use of those funds afterwards, in terms of being as tax efficient as you can going forward. So that's lots of the conversations that we're having with clients around CGT. And then looking at pensions, as you say, many of those individuals will have a number of different pots. It's probably the right time to consider a review of the pension situation, understand what your pension looks like in the context of the new pension rules that only came into force really this tax year with the completion of legislation, and considering, do you need to take some action now in this tax year? Does that need to be ahead of the budget potentially, and what that might look like? So they're really the main two conversation points that we're having with clients at the moment.
Thank you, Shaun. Perfect. I think that's been hopefully a helpful conversation for those at home. If you'd like to hear anything further about what we've discussed today, please get in contact with us.